everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Sean Cota. He is the former chairman of the Petroleum Marketers Association. Sean, great to have you here. Thanks very much.
Thanks for having me.
I was really excited that you were coming here today because it's been a while since we spoke, and I know you have been a very outspoken voice when it comes to commodity market, financial sector regulation. In fact, your old business, your family business that you were involved in, you were a heating oil distributorship. So you really represented the voice of, the independent, let's say small or mid-size sector of the market. And I remember you speaking frequently, testifying before Congress about price manipulation in the market. So I really want to get your take now, and I know you're down in Washington, about the post-financial crash environment, the current Dodd-Frank environment. What has changed, if anything?
Well, remember the one thing we learned from history. We don't learn from history. So Dodd-Frank went through. I think in the derivatives area, which I was very involved in, Title VII, there were a lot of really good reforms built into it, but like any other political issue, if you can't kill it in Congress, then you modify it so you get your things that you want in the bill, and then you vote against it anyway, and then it goes to rulemaking. I like to give the example, rulemaking is where they decide that paper plates will be white, and then you define white in rulemaking as purple. And so there's a long process of that, and then if you don't like the color purple and that wasn't good enough for you, then you fight it. And Scalia, the Supreme Court's son, is a very competent and very wealthy litigator who successfully has put a stop on the position limits rule, which is one of the key elements that we were concerned with. And now that's in a long, slow process to define who the end users truly are. Now, the end users, from my perspective, were people like my industry, right, that hedge for their consumers. But they have other companies that do very little physical delivery of any product, physical delivery or receipt, that were classified as end users.
Yeah, I remember a factoid that I came across one time, that the largest owner of physical heating oil in New England, which, by the way, in the New England area, New York, New England, heating oil is the primary heating fuel. The largest owner of physical heating oil was Morgan Stanley, which I think most people would be shocked to find that out.
Well, in general terms, it was more than just heating oil. It was physically stored product, because they had a bunch. That was true then. I haven't looked at their numbers now. Of course, they're in the middle of a sale to Rosneft for their oil division. But they had Transmontane.
The Russian firm.
Right.
So they're not affected by the sanctions against Russia?
Funny how that works. No, currently they're not under that regime. I think it's scheduled to close in 2 months unless something happens, maybe 3 months, oddly around the election time.
Gee, isn't that a coincidence?
So, but at the time they were the largest physical holder ahead of ExxonMobil in physical storage, but they had Transmontane, Morgan Stanley Oil, Morgan Stanley Shipping, where they'd store it offshore, and all sorts of other plays that feed into that. They've liquidated some of those positions in companies and have gotten minority positions. Interestingly enough, just yesterday I noticed that they're moving into the NGL distribution and export markets.
That's the natural gas, liquefied natural?
It's more. It's ethylenes, propylene, butane, propane, in order to export those, because there was just an export waiver that was given so that, like refined gasoline and diesel, that you can export to the world market, that now we can export all of these products.
I'm glad you raised the subject of exports, because we see now an expansion in export licenses for natural gas. The administration has just recently allowed the export of crude oil for the first time. Is this a wise decision? I mean, because we hear a lot of talk in this country about wanting to achieve energy independence, and we've seen a big increase in our own domestic production because of new drilling techniques and whatnot. But now we're just sending it off to the foreign sector? I mean, isn't that a bounty for us and our future generations?
I think it is a bounty in a lot of ways. Crude oil exports will be very problematic, I think, exporting. The natural gas, my personal opinion is that there's a significant amount of it out there, and that it's going to still have a surplus even if you put up some of these facilities. There's like 60 that are asking for permits. I think they're given permits to 3. Even if they went to 6, I don't think that's a big impact. And you need to rebuild the entire energy infrastructure. That's why the railways are doing well. That's why the XL pipeline won't get built, because Berkshire Hathaway's rail division really doesn't want that to be a competitor for some of the logistical solutions that they're providing.
And we don't just need to rebuild the energy infrastructure. I think we need to rebuild the entire infrastructure. I think there was a report that said just to rebuild the bridges in this country is something like a $4 trillion project or something.
Those are the things that we should be doing, but Congress refuses to act in any intelligent way. They'll continue high-velocity policies like unemployment and food stamps and WIC, things like that, which you need to do because then people will be getting out their pitchforks. But you need to also be developing infrastructure. That's going to pay off for a huge amount of time. And our energy infrastructure was built in World War II, and we're only starting the process of rebuilding all of that.
No question about it. Everything that you have on you, everything here came to us by some form of truck on the interstate highways, which were built back in Eisenhower's time, and that's an investment that's still paying off. You talked about velocity, which is great. You keep coming up with these keywords that lead me to my next question. I want to talk about high-frequency trading. This has become a big issue. A lot of people saying it's another distortion for the markets. What's your view on high-frequency trading?
All markets are rigged. There's just to the degree and whether or not you can see what's going on so you can anticipate it. High-frequency trading really lends itself more to commodities, and we're here at the NYMEX, which is key for that. You need to have uniform contracts in order to make it work. The volumes that are required are huge, and that's why they rent space for the servers here so that they can get the trading done as quickly as possible. In order for any trade, you need a sucker. They say if you're going to the poker table and you can't identify the sucker, you're it. Well, I think the massive passives have been the suckers, and the volume in those have been declining. The oil index funds, natural gas index funds,
is that just a function of prices have gotten a little bit more static, volatility is down, so it's not attracting that sort of element anymore?
I think even the endowment funds and the pension funds that have been sold this diversification story have come to realize that this is a bad investment all the way around. Because a commodity, if you're not going to take physical delivery, you've got to roll the contract. Yeah. So you never buy just the front month. You've got to buy months in the future. That if the market's going up, that's contango. So you're going to pay more in the future months. And when it declines, what goes down faster? The outer months, right? And backwardation. So on the way down, it goes down much more rapidly than it goes up. And these massive passives just get very poor returns. But they're needed in order to create the front running that occurs in these markets. And I think that is declining to some degree.
So is it a good thing that the massive passives, pension funds, endowments, that sort of institutional investor, if they're pulling back, I mean, do you view that as a positive for the markets?
I think that's a positive for the market. You're going to start to get some supply and demand reflection in the markets. Before, it's really been about money flows. Where's the money coming from? How much money is moving into these markets? Because the physical market is dwarfed by the paper market. At one point, I did a calculation that the world's annual oil consumption is traded 8 times a day. Well, that's good if you're a high-frequency trader, but if you're any end user, true end user, producer, or buyer in those markets, you don't roll those positions that often.
Yeah, that's the definition of the tail wagging the dog. Sean, thanks so much for coming here. I really appreciate it.
My pleasure.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.